presentation is for information purposes only and doesn't constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading foreign exchange, futures, cryptos, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial conditions. Past performance is not indicative of future results. Hi, this is Ahmed. Welcome to the first session of Introduction to Global Financial Markets. We start with one-line definition of this business. Online margin trading in stocks, commodities, Forex, and cryptocurrencies. And that's it. This is the one-line definition which one should understand after attending this even very first lecture of this business. One should be in a position to understand and explain to others what this business is. If we go in detail of this line, so it's simply trading online on margin trading facility in stocks, commodities, Forex, and cryptocurrencies. We'll further explain it. So basically all these are the products which are being traded in national or international exchanges and markets. And all we need to know is we have to trade it online and on margin facility. So once we learn now what is margin trading or leverage trading, then trading all these global products online is what this business is about. So first of all, before further explaining this business and this definition, let me explain to you what comprises global financial markets. Whenever we talk about global financial markets, what comes into our mind? There are basically four areas which we need to understand. First is stock exchanges. Like every country has a stock exchange. Famed exchanges of the world are like New York Stock Exchange or London Stock Exchange, Shanghai Stock Exchange, so on. In Pakistan we have Pakistan Stock Exchange. There can be one or more exchanges as well. So these are the exchanges where basically the publicly registered shares are traded. We also call it securities. So this is the one part, stock exchanges. Second, it comprises commodity trading exchanges. Likewise, stock exchanges, every country has at least one or more commodity exchanges as well, where we trade commodity derivatives and other listed derivative products, like the CME group being the largest one so far, and Chicago Board of Option Exchange, New York Board of Trade, Intercontinental Exchange, New York Mercantile Exchange, London Metal Exchange, so on. In Pakistan we have Pakistan Mercantile Exchange. So in all these commodity derivative exchanges, the listed derivative products are being traded. So this is the second avenue. First we discuss stock exchanges, then commodity trading exchanges. Next there are off-exchange capital markets, where we trade foreign exchange or FX or Forex or cryptocurrencies and some other CFD trades. So these are the products which are not traded in exchanges, but it's a major segment as well. So this is the third one. Then in fourth place becomes investment management companies like asset management, portfolio management, mutual funds, hedge funds. So all these type of funds, these also of course belong to global financial markets. Someone is buying or selling mutual funds. So this is the fourth segment. Now, why we are learning all these things? So first of all, we just understood that when we talk about global financial markets, it means we're talking about trading international stocks or shares or commodity derivatives like gold, silver, crude oil, currencies, then some off-exchange products, foreign exchange or FX or Forex or cryptocurrencies like Bitcoin, so on, CFD trades, which we'll discuss, as well as some funds. So trading and learning to trade all these products is covered in this business, which we call basically online trading business as well. So once you learn this online trading, you can either invest yourself and become investor, or you can trade for the clients and share profits. You can give them trading advice or recommendation via research and analysis in multiple ways and earn handsome amount for respectable living and career in financial markets. Before further going to detail, let's summarize so every one of you should have the idea. As we just discussed, these four are main pillars of global financial markets. This has been developed only by keeping this factor in mind that individually one has to learn and how individual can take benefit out of it, keeping some other financial services provided activities separate, like banks or leasing companies or insurance companies, because this is something which comes under corporate sector, and one individually cannot open a bank like this. So at initial stages, if we learn these four segments, it means we can take multiple benefits while being at home. Wherever we have internet facility, we can trade shares of any country, any company, likewise commodities, FX, cryptos and funds. So by learning this, we'll have the benefit of trading all these markets. And of course, if you have to buy, for example, shares of, say, Microsoft, so what's the process globally? You don't have to need to go to Microsoft direct. They will ask you to go to the member or broker who is of the same exchange where the shares are listed. If the shares are listed in NASDAQ, so you will have to contact a member who is a member of NASDAQ exchange, and then you can buy or sell share of any company which is listed in NASDAQ. So now here comes you, whether you can be investor or trader or advisor. So you have to go through a broker member to buy or sell respective commodities. So it comprises the whole business. Before explaining it, what this business is in more depth, I just want you to make a mind what should be the benefit out of it if you learn this type of trades. So I always believe you should have a target, first of all, a clear roadmap, what you have to do, what will be the benefit. So you can't hit a target if you can't see it. You can't see a target if you don't have it. And you can't have a target if you don't dream it. So this is a cycle which you should captain your mind being an entrepreneur. So it will give you self-motivation and the reason why you are learning this. After that, once you have a basic information and some experience, as explained earlier, to trade all these 4 different markets. You can become a financial analyst, a consultant, or hedge fund manager, mutual fund manager, asset manager, portfolio manager, investment manager, or financial broker, stock broker, commodity broker, financial trainer, as well as financial software developer as well, because to develop a particular software, if you don't have the product knowledge of that particular domain, you can't expert it. So all these are the avenues open in front of you, and these are your future financial career options. Now let's finally start. As I start with one-line definition, so there we discuss, if we go back and see, online margin trading in stocks, commodities, Forex, and cryptos. I already explained these 4 asset classes in detail. It comprises the whole financial market. So it means, by learning this business mean, online trading of these products while being at home or wherever you have the internet access, whether through laptop or your smartphone, using margin trading facility. So it means, if you understand what is margin trading, rest of the things is already explained. So it means trading all these products online on margin. So let's start with the margin trading. Basically, margin trading is like leveraging your investment. It gear up your investment. And let me give you an example of real estate broker. If, for example, you have to buy a property of worth $100,000, you go to any real estate broker and give some initial amount, which is generally called token. In our language, it's called basically initial margin or performance bond or guarantee money, but this is just for the purpose of explanation to you. He said, okay, if you want to hold this property of worth $100,000, just give me 1% of it and I'll hold it for you, say 30 days, and within that period you have to pay remaining 99% and get it transferred. So you pay 1%, which is $1,000, to that real estate broker and hold that property, and further sell it to $105,000 to some other customer, and you make a profit of $5,000 out of it. Now if you review this example, you invested basically $1,000 and you had a profit of $5,000. Why? Because your profit was not based on merely $1,000 initial investment, because the whole size of the investment, which is called contract size in our financial term, was of $100,000. So by paying that marginal amount of 1%, you basically traded a whole contract of $100,000. So this example is like your investment is geared up, and this is called initial margin in our financial sector. We use this term. So trading using this facility where you have to pay a marginal amount, which is generally between 1 to 5%, and that gives you the power to hold 100% equity, and the profit or loss is based on that whole contract size, is called margin trading. So here comes a question. which is generally asked, that this is the most riskiest business on earth. Yes, that's correct, but it's a double-edged sword. So if you have a profit of $1,000 against 1% move, so it's in both the directions. If the market is moving against you, you will have 1% loss, which is say $1,000. So this gives you the power that with least investment you can hold multiple time profit. It's exactly, if you take an example of two friends, both are working to forecast the move of, for example, gold, and one has $100,000 physical with him and plan to buy the gold physically, right? And the other one is not having $100,000. He has say $5,000, and he opened an account with some exchange or broker which offers him the gold trading in say 2% margin. So out of that $5,000 account, he put $2,000 and buy gold of worth $100,000. They both planned and forecasted at the same time and same price they bought. After a day or so, both liquidated once their target is achieved. And for example, they both liquidated at the same time and price, so both will have same profits. If a friend with 100,000 physical investment in gold made a profit of $5,000, the other also made a $5,000 profit, although he invested $2,000 and still $3,000 was remaining. So why? Because of using this margin trading facility being provided. Generally in this field, we have most of the product available on 1% margin, which is called 100-to-1 leverage. This is very common terminology which you should know while bargaining with the brokers or exchanges, that you should understand these terminologies. We'll explain each and everything in detail in next lectures. What are the types and the contracts and the other things which you need to know. Right now, the only thing important in this session is you need to know what is this business and what is leverage or margin trading. Likewise, if some broker is offering you 50-to-1 leverage, means your $1 is acting like $50, so it means you are on 2% margin, and so on. There are some brokers who are offering 200-to-1 leverage as well in some major currency pairs like euro, British pound, so on. It means in that case you will be on 0.5% margin. So after you understood what is margin trading, we can summarize with this statement. This business is like trading Microsoft shares on margin online from your home. This business is like buying or selling gold or crude oil or other commodities on margin. This business is buying Bitcoin or other cryptocurrencies on margin, and likewise shares. All the terminologies are almost same. We'll go to discuss all these in details. Whether you have to trade euro currency or gold or Bitcoin or Microsoft shares, everything is similar. What you need to know as far as the technical analysis is concerned, risk management is concerned, forecasting is concerned, some other measures are concerned, this is what we'll be discussing. So you will have this knowledge of trading all these products over a click of mouse. Now another important aspect which you should need to know is, then that is hedging. Hedging is basically one of the main reasons why the commodity exchanges were developed. In 17th century, the first online exchange was developed in Japan. That was Osaka Rice Exchange. Let me explain you just to give you an overview. Why? Because this is very important to understand. In nowadays business, most of the products are unable to be traded in any physical business if this facility of margin trading is not there. For example, if there is a gold trader, wholesaler, which is, for example, requiring, say, minimum 6 to 8 hours to bring the gold to the respective country he is living, whether he is bringing gold from Brazil to Europe or Switzerland to some other country, or South Africa to, for example, Saudi, or he has to bring gold from Dubai to India or Pakistan. In any case, generally he requires 8 to 10 hours, even if he is super fast. And practically speaking, in nowadays gold move, he can't afford even sometime movement of few minutes, because if he's buying a gold of worth, say, $10 million, and by the time the gold is here, he might have maybe $100,000 profit and loss in few minutes, and this will become inevitable for him to do business. So what he'll have to do, by the time he purchases gold of, say, $1 million, at the same time and price, he sell the same quantity in any other market of whether it's exchange of his respective country or any other global exchange, because gold is globally traded at same price. Now, since he's already investing $1 million on gold, by investing, say, 5% extra, he opened an account with any exchange which provides him gold trading facility in 1 to 2% margin. So where he can utilize this facility, and to sell $1 million gold, he need to have, say, $10,000 in his account. So by investing $10,000 extra, he basically protected his $1 million. Why? Because now by the time he reaches his destination, wherever the gold price is, it could be $100,000 up or $100,000 down, which is a normal routine nowadays. So in one position he will be having $100,000 profit, and in other position he will have a similar loss, which will cancel each other. So basically hedger is having two positions. One is physical position and one is position in the financial markets, which is speculative apparently. Both are equal in quantity and opposite in direction, because he bought physically, so he will always sell in financial market, because his purpose is protection of his asset and not to make profit out of fluctuation. So this way this business becomes visible. Otherwise it's not possible to trade gold nowadays. Likewise, you can take example of copper, which is used in cable industry, and it's almost moving side by side with gold and other metals. So the cable manufacturers need to buy copper regular intervals, and they need to hedge it. They also do the same thing. In every country you can have dozens and hundreds of examples. For example, if somebody is importing electronics or Japanese cars. So definitely he'll have to pay in Japanese yen, and if he's holding any other currency which is fluctuating, it might hurt his profits. So what he'll have to do, he'll have to protect against Japanese yen, so he'll have to hedge the Japanese yen currencies. So this was one of the major reasons why the commodity exchanges were developed, and any trade which is not for the purpose of protection of the asset is a speculative one, where we intend to make profit out of routine market fluctuation using this margin facility. Okay, now we cover a few major examples one by one, as we just discussed the 4 examples. First one, what is Forex trading? Forex is a combination of 2 words, foreign exchange. We also call it FX trade, or spot trading, or interbank trading, or spread trading, or cash trading. These all are similar names. Similar trading in foreign exchange. Since currencies is always traded in pairs, if we say we are trading euro, it means it is basically euro USD. IMM, International Monetary Market, whenever any currency is launched, basically they set these things. If it's greater in value than dollar, so it's represented here, EU. First 3 digits of the currencies are before the USD, and Japanese yen, Japan rupees, Indian rupees, other currencies which are less in value than dollars at the time of launching. So then USD is represented before. That's why when we write PKR, we write USD PKR, and when we write euro, it's EU or USD. Anyway, so as we just discussed, this is also called spread trading. Why? Because this mechanism is same like the money exchange company. If you have $100, you want to change to any other currency. If you want to buy that currency, we give you a different price, which is the asking price, which is higher than the price which if you want to sell, you will be receiving, which is called bid price or selling price. So the difference of this bid and ask, selling price or the buying price, is actually the spread, which is the benefit of that exchange company in that example. And here this spread goes to the broker, which technically speaking is much lesser than money exchange company. Once you will go to the practice and trade in SIM account or demo account, you will clearly notice this. Generally, the margin in currencies is 100 to 1, which is 1%. And in some scenarios, you have to pay overnight interest. Why? Because you are dealing in a pair of currency which comprises 2 currencies. Every currency has interest rate set by the respective central bank, which we'll discuss further in second class. If you are buying the currency which is having more interest than the other one, so of course you will receive something, otherwise you'll have to pay. Anyway, this is called swap, overnight interest. A lot of exchanges and brokers nowadays have started offering Sharia compliant Forex trading as well, where nobody receives or pays the interest. Then it simply becomes a business like money exchange company with the difference of margin. We will discuss this aspect in a separate video. It's a very detailed subject and need in-depth knowledge, and we'll discuss it in a separate video as well as the Sharia compliant part of the trading is concerned in all the types, whether we're talking about Forex trading or futures trading or options trading or CFDs trading or certain shares trading or cryptos, whatever. And here only I would like to say one point. One must need to have this knowledge. It's like commercial banking and Islamic banking. Conventional banking is there as well. If somebody is not going for the interest-based conventional banking, that doesn't mean he says, no, I will not open an account anywhere in the world. He will be stuck. A lot of system will be stopped. He can go to Sharia compliant Islamic banking. Likewise, here are some products and types which you can select which are Sharia compliant. Anyway, so this Forex is 24 hours actually and has no expiration. Like if you buy euros, you keep it with you maybe for 1 day, 1 week, 1 year, up to you. Lifetime, inherit to your children. Here, similarly, you can hold these products till the time you want. Actually, it's 24-hour trade, but some of the exchanges have, our brokers generally have 1 hour break. That we'll also discuss in the next class. What are the different timings and how this break and other thing works. Then this Forex trading is a two-way market. I mean, you can sell the things before you buy. Whether you sell first or buy first doesn't make any difference. It's called half term. And to make one complete round term or trade, you have to make buy plus sell or sell plus buy equal quantity. So it makes one transaction. Of course, if the product is moving up, you can buy like in traditional cases. But if it starts dropping in prices, it's going down. So instead you wait that where it will stop and then I'll buy, like most of the traditional shares. You can sell it, and then, for example, you sell something at 100. The market is 90. You buy it back. So it means you take it other way around. You buy something at 90, sold at 100, giving you profit. So these are some of the basic points of Forex, which can give you just basic overview. Now next, as we discuss, is what is derivatives trading. Derivatives, as you can clearly sense from the word, these have been derived from spot or cash market. And we just discussed spot market. Why we call it spot market is, one reason is we call what is at the spot price of euro, for example. I want to trade in that price. So it means one is referring to trading Forex, trading euro in FX here. And now if somebody is willing to buy a future euro, which is a completely different product, it has been derived from the source, and the source is cash price or the spot price. That's why we call these are derivatives, and these are derived from different sources. In exchanges, generally derivatives are being traded. Why? It's a long subject again. Not only for derivatives, for even one particular type of derivative, we have separate lectures. But few of them, just for your basic information. If you have to trade a product in the marketplace like exchange, you have to standardize it. It's like if you want to go to money exchange, you can say, okay, I want to buy 100 euros. Likewise, if you are trading Forex, you can trade less amount or more amount depending upon, there are mini contracts, micro contracts, a lot of other things which we will discuss further. But if you go to exchange and you say, okay, I want to buy euros of worth $100, then you say, sorry, we have our own standard. If you have to trade in euro, the contract size is 125,000 euros. So you can either trade 125,000 euros or its multiples. And that contract size is specific, fixed. You can trade its multiples. Alright. Hope you got this point. And then there are many other things like point value, minimum fluctuation, tick size, expiration, because unlike in spot market futures or derivative, any other derivative, they have got expiries. Some derivatives expire on monthly basis, some quarterly basis, like this. They have specific timing of exchange, although after that exchange there is electronic session available, and in most of the product again it's like 23 hours market. But exchange has got its own rules, specific contract sizes, specific commissions they charge per transaction. So for the purpose of standardization, these derivatives are made, and a lot of many other association reasons. But just for overview here, it's enough. So like we discussed in Forex, there is margin. Here also it works on margin. It's similar, and generally it's between 1 to 5% for various products. Again, it's two-way market. You can sell before or buy before. Doesn't make any difference. And these are traded on monthly, 2-month, and quarterly basis. For example, most of the currencies in stocks are traded on quarterly basis. Gold is traded every 2 months, and crude oil, and there are some other products which are also traded on monthly basis. They have got one other difference, which is a month symbol. Since they've got expiries. So for example, if somebody is saying I want to trade derivative of euro, for example, futures, because when we say derivatives, there are different type of derivatives like futures trading, options trading, CFDs like contracts of difference, forwards, swaps, swaptions, over the counter, so on. So if somebody says, okay, I am trading future euro, so then the broker will ask which euro future, which month in euro. So he'll say, okay, I want to buy March euro or June euro and so on, because euro future is traded like all currencies on quarterly basis. So it means we have to represent it. So there are certain specific symbols, like for January it's F, G for February, F for March, J for April, K for May, M for June, N for July, Q for August, U for September, V for October, X for November, and Z for December. So these are the month symbols which are being used in derivative instruments. It means if somebody is trading March euro, you need to understand March euro is totally a different product from June euro, and so on. It has got, we'll discuss in futures trading lecture in some other class, not in this session, that why there is a price difference, what are the types, what are inverted and reverted markets, cash carrying market, stuff like that, how these are developed. We have got fixed formulas to evaluate the price of, for example, March euro from euro USD, which is in cash market and spot. And again, this product euro USD is different than all these futures as well. Okay, and also they have got deliveries. There are two types of say if we are talking about futures, there are two types of futures, deliverable or non-deliverable. So those who has got some physical value, they are deliverable, like gold, crude oil, silver, wheat, soybean, sugar, so on. So if somebody is hedging it and he wants physical delivery, so he will have to pay remaining margin upon expiry. There are certain expirations, and otherwise it will be cash settled. So these are some of the terminologies which are associated with this derivative trading. But at this stage, you just need to know some of the differences. Then what is the difference between derivatives and others? Okay. Now next is What is stock trading, which is also called shares trading or securities trading? Same name of different, terminologies. If somebody is saying I trade securities, if you should able to understand he's talking about stock market. And as we discussed, stock market is publicly limited companies' shares which are traded in that particular exchange. And again, it's exchange based, standardized. There are variable bid and ask and specific time for the exchange. Generally, after that time, shares are not trading. This is one backdrop. Commission is there, tip size, tick size, it's there like in futures and spot we discussed. Margin is there, but it rarely trade on it for very short term. Sometimes some exchanges allow, and this is generally, that's why one-way market. We cannot hold short selling long time for certain days in certain exchanges that are allowed, but generally you have to buy and hold. And there are different type of shares: common stocks, preferred stocks, convertibles, so on. You don't need to go to understand these details at this level. And then there are some dividends being distributed, some warrants, some rights which comes with the common stocks and other things. Then sometimes they offer stock splits, reverse stock splits based upon certain financial conditions of the companies, and they need to have more funding or stuff. At least you need to be familiar with this terminology. Non-Sharia compliant stocks. You will find this thing in almost every asset class and type of trade. For example, although it's again not the topic, just for overview. For example, if you are trading in the shares of a company like commercial bank, so which involves the interest, so it will not be allowed as per Sharia Islamic laws. And if you are trading, for example, in a cement shares or Islamic bank share, so of course trading on these will be allowed likewise. Some other issues related to stock trading is, as we discussed, one is the liquidity risk as well, because of the volume. The volume is low in that particular share. So sometime if you have to sell the share, you are not being filled, you are not getting favorable prices, market is crashed, coming down, so you have to forced to sell at worse price. This is one concern. Then of course trading time is another concern, because it's generally in most of the countries traded in their respective 9 to 5 timing. In some countries even less, but in some countries there are some electronic session as well. But again, there is a gap, and during that gap, if anything happens, some bad news comes which might affect that company for which you are holding the shares, so you can understand you won't be having the chance to liquidate those shares during that time until the market reopens. So it has some handicap. Then currency risk is there, which respective currency you are trading in your. If you are trading in Pakistan, for example, of course they won't accept dollars, you have to trade Pak rupees. So if Pak rupee is going to be devalued, so you will have to take care of it as well. Then there are sometimes some insider trading issues as well, and some it's being one-way market factor we have already discussed. So this was some of the basic overview for the security market or stock market. Now in the end of this session, what is cryptocurrency trading? In nature, representation wise, it's like spot trading, because there is a spread as it's in cash trading, and it's basically traded at exchanges as well as with some brokers, so it's off exchange product as well as exchange basis like Binance and some other exchanges are there. Now the technology which is being used for most of the cryptos, it's blockchain technology, especially like the Bitcoin is being traded on it, being the most famous. To understand blockchain technology, again it's a detailed topic, but just for overview you can say it's information which is stored on a block, and every block has three basic information stored. One is the hash address. Just like IP address, there are some digits, combination of digits and letters. Then there is hash of previous block. We call it HOPB. So hash is there on every block, HOPB is there, and that particular transaction detail. Whether somebody is, for example, buying, it's not only with the cryptos. In many countries, for the payment processing, it's being used now, and to regarding a lot of transactions, because this is one of the secure way. I'll explain you in next few minutes. In case of Bitcoin, for example, if somebody is buying Bitcoin, somebody is selling Bitcoin, of course there has to be a buyer and seller to make a transaction. So that is stored on a particular block, and when another transaction occurs, the next block occurs. The next block takes hash of previous block and that particular detail of current hash and that transaction detail. So one block, next block is completed. Then further for third block, it will uses again hash of previous block. So to change any information, you need to change millions and billions of blocks details, which is practically not viable. That's why this is one of the sound system of transaction. And other than that, the other benefit is it's eliminating all intermediaries like banks and money exchange companies, which are of course charging huge. If you have to send bank wire, there is involved cost as well as spread, transaction fee, blah blah blah. And here, like, it's peer-to-peer between buyer and seller direct. There is no bank or money exchange or any processing company in between, which really removes the cost. And at the same time, as I explained you, the nature of block in blockchain technology is soundproof as well. So security is there, transparency is there, and this less cost is there. So this is one of the reasons it has been accepted by CME as well now, which is world leading exchange in the US, and many governments are being adopting it very quickly, and that's why the trend is going on. And here, for the purpose of exchanges, miners come into it, which serves as the purpose of exchanges, and miners serve purpose of cryptocurrency exchanges using hash power charging some micro coins as transaction fee, which is comparatively very less on buying and selling. Spread, difference of selling buying price, as explained, it's there, but it's very phenomenal, and it's being negotiated between buyers and sellers. So it's not like that traditional fixed spread or something, but those who are trading on margin, they have to negotiate with their broker what spread they are going to be charged in particular products. And here margin is very less because it's too much volatile. So being volatile in nature, generally 20 to 1 leverage is being offered, which is like 5%, and some are even higher. Swap, I mean, it's interest free, swap free, so this is already Sharia compliant in nature like this, and they've got no expiration like Forex, and the base currency is US dollar, and it's again two-way markets like we discussed for the Forex. There are more than 3,000 coins available. Most of these are illiquid. This is one of the issues, because if we talk about Bitcoin, or you find huge volume, you will find buyer and seller all the time. Whenever you have to liquidate your position, there is no issue. But out of those 3,500 plus coins, if you select certain coin which is launched new, you have to have complete research while adding any coin to your trading basket, that what are the trading volumes, so that in case if you buy it and at certain point you want to sell it, so there has to be some buyer. And in such a liquid, of course, spread is huge, and there is a liquidity risk and counterparty risk as well, especially in those countries where regulations are not defined yet. Because if regulations are defined, broker will be given certain rules to follow, and they'll be monitored, so making it comparatively secure. So these couple of things you have to be careful while trading Bitcoin or Ethereum or Litecoin or Dogecoin or any other cryptocurrencies. Summary. We discussed one-line definition, that online margin trading in stocks, commodities, Forex and cryptocurrencies. This is what this business is. Then we discussed various types of global financial markets, stock markets, commodity markets, off-exchange markets, and then other investment companies providing mutual funds and other investment vehicles. And then we discussed, this is one of the ways to learn for our own self as an investor or trader or advisor, and become financially independent entrepreneur as a self-employed. You can work from home, especially in these days of COVID. It's a great knowledge to acquire, which will be helpful for you while being at home. You can trade your funds or customers' funds. And then we discuss what are the possible careers for you. It's a huge potential. Then we discuss margin trading, Forex trading, derivative trading, especially in futures and options. We'll have a separate set of lectures for options trading. That's a typical example of derivative. And then we discuss stock trading or shares trading or securities trading and the cryptocurrency trading. So here the first session is ending. Just overview of what we will discuss in next section, session 2. We'll discuss some asset classes like currencies, cryptos, commodities, and again what type of commodities are available to trade, energy, metals, so on. And then various global stocks, stock indices, and stuff like that. We'll discuss major financial hubs which really make impact, and key global market timings, what are major central banks, what are leading global exchanges, which trading platforms we have available worldwide to trade, how the orders are executed, how you can buy or sell, what are the various order types, product symbols, contract size, and profit loss calculation. So see you in next class. Thanks for your time.